Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and our topic today is long-term debit financing. So, usually loans or bonds. So first we will be talking about loans, then we will be talking about bonds. So the assets or other financial resources available to a business are called capital. Purchase of planned assets used in the operation of a business are called capital expenditures. Asset pledged to a creditor to guarantee repayment of a loan are called collateral. I will take money and then I offer them my house. If I don't pay it, they can take my house, for instance. So what do we have? When we apply for a business loan, what kind of questions they will be asking us? What portion of the funds will be used for revenue expended and capital expenditure? The more money for capital expenditure, the better for the bank. They will generate more money. Business experience. What experience do the primary owners and managers have in the industry? Are they a newcomers? Do the decision makers understand how to operate the business? Can they anticipate problems and react to ensure success? If they have experience, if they are for a very long time, so it's easier for them to repay it. Market demand. Is there a proven consumer demand for the product or service? What competition does the business face? Financial projection. When will the project become profitable? Because if they are not profitable, they will not pay the bank back. What assumption is the business using to make its projections? And collateral. What assets will be offered as collateral that could be claimed if the business is unable to pay the loan? How easy will it be to resell those assets? And capital profile. What is the business risking in the project? Does the business have an adequate stake in the project to ensure management is motivated to succeed? So if, after all these questions, they agree to give us money, then we have these journal entries here. So here, transaction 1, signing a note, April 1st. Sign a 5-year, 8% note for $120,000. So our debit, cash, document, receipt 628. Debit, 120. And credit, notes payable. Okay, specific journals. Not cash payment, but cash receipts. So the first one here, April 1st. Accounting title, notes payable. Doc number, receipt. We can link here. Receipt 628. A credit for notes payable, 120. It is not accounts receivable or sales, and cash debit, the same number. Okay? And then we are paying it. And here it is a monthly payment. So, okay, after some month, we are paying it. So let's, for instance, the July 1st. Whoops. We are paying it. However, we are paying principal plus interest. So debit, notes payable. Debit, interest expense. A debit here. And credit, cash. So check number 673. A debit. How much the principal? 1,655. Interest, 778. Cash is the sum of both, 2,433. So, okay, now this is a cash payment. So, okay, we have a lot of cash payments before that, but we are paying here notes payable. We are debiting notes payable 1,655 and also interest expense. And check number 673. A debit here 778. And the cash payments, cash credit, can be on either of these two lines here, two rows here. So no problem at all. Okay, so the sum of debits, the sum of these debits here, the sum of credit cash. We are not working with, whoa, how are you? Okay, here. Okay, the same, 2,433. How do we find this number? How do we find these numbers here? It is based on what we call amortization schedule. How do we do an amortization schedule? This is a bonus for you guys. Amortization schedule here. So, let me delete, and we are doing June. So let me delete everything here. And then we will be doing until December, okay? We would have 60 rows here because it is 60 months. So what do we have here? The loan, 120. Oh, we have no numbers here anymore. And then payments, 2,433 and 17 cents. Period is 5 years. However, our payment is monthly payment, so 60 months. And the interest, 8%. So 8% per year, that is divided by 12, 0.67% a month. So how do we do that? April, where we took it, our carrying value, that is our ending balance, how much we own, 120. The payments, 2,433 and 17. So let's copy and paste. It is the, so no. Here it is the same number. Let's copy the formula. How do we split the number in interest and principal? The interest is also the beginning balance or the previous balance times our interest rate. And if we press F4, this double dollar sign here, if we copy and paste our formula to anywhere, this B5 will be locked. So it's how we lock. So 800 and paste the formula, nothing because we have nothing here. And the principal is the difference between the payment and the interest. And the new carrying value is beginning balance less principal, because the principal is our debit on notes payable. Okay, and then let's double check this number. Now we can copy and paste these formulas. And here we are. So this is how we do our amortization schedule. And then at the end of the 6th month, then our carrying value will be nothing. So this is how banks do it. So 778 and 15 matches 1,655 and 2 cents. Matches here. Cool, huh? Perfect. And what about bonds? How bonds work? A long-term promise to pay a specified amount on a specified date and to pay interest at stated intervals, usually twice a year, is called a bond. And then I can sell this bond to anyone. Anyone can purchase it. All bonds representing the total amount of a loan are called bond issue. The process of selling bonds is commonly referred to as issuing bonds. So we can get money from anyone, not only banks. And the face value is the amount to be repaid, and the interest rate used to calculate periodic interest payment on a bond is called the stated interest rate. So let's go here. Again, and guys, this file is on our video description, so download it and subscribe to our channel, please. Issuing bonds, issued 20 years, 60.5% the interest rate, 5,000 bonds. And the face value of all of these 5,000 bonds is $180,000. So we will be paying $180,000 in 20 years. And what we will be paying until 2041, for instance. Twice a year we will pay the interest. So okay, we are issuing it July 1st, cash, and credit bonds payable. Just like any other payable. And here receipt 766, $180,000. $180,000 here, $180,000 here. Debit cash, so it's cash receipts. When July 1st, how we are getting this money? Bonds payable, receipts 7, wow, a lot of 6 here. 766, a credit 180, and cash credit 180, cash debit 180. Cool. Now the December 31st, after 6 months, so July 1st, August, September, October, November, July, August, September, October, November, December 31st. Paid cash for semi-annual interest on bonds 5,850. How do we find this number? Total bonds divided by, multiplied by 6.5%. However, it's semi-annually, so divided by 2. 5,850. So here, December 31st, it is only interest expense and a debit, and credit cash. So no bonds payable here, because bonds payable will be paid only in 20 years. Check 892, 5,850. And here a cash payment, December 31st, another interest expense, a debit, 5,850, cash credit, 5,850, and we can add, just like here on row 11, we can add here the totals. You can add all of these totals here, and our numbers are matching. That's it, guys. Thank you so much. Questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.